In this video, we master the art of adjusting covered calls for maximum efficiency. A covered call is not always a set and forget strategy. It requires active management as market conditions shift. When your trade assumption changes, you must decide whether to close the position, accept assignment, or roll the option to a different strike or expiration. The goal is to maximize the premium collected while protecting your long stock equity. Scenario 1. The stock rallies aggressively, and your short call is deeply in the money. You have reached max profit, but you may not want to lose the shares due to tax implications or long-term bullishness. In this case, you compare the benefits of letting the shares get called away versus rolling up and out to capture more potential upside. To roll up and out, you buy back your current short call and simultaneously sell a new call at a higher strike price and a later expiration date. This process should ideally result in a net credit, meaning you are paid to extend the trade. This raises your profit ceiling and gives the stock more room to run. Scenario 2. The stock price drops significantly. Here, you play defense by rolling down. You buy back the decaying short call for a profit and sell a new call at a lower strike to bring in additional premium. This lowers your cost basis, but be careful. Do not roll your strike price below your original stock entry price unless you are willing to lock in a loss on a rebound. Finally, remember that taking assignment is not a failure. It is simply the realization of your max profit defined at entry. If rolling cannot be done for a credit, or if the capital can be deployed more efficiently elsewhere, allow the shares to be called away. Don't chase a bad position by rolling endlessly into liquidity traps. Master these adjustments to turn static positions into dynamic income generators.